Hello, welcome to Real Vision. I'm Maggie Lake. With me today is Warren Pies, founder of 314 Research. We're going to take a deep dive into the inflation debate and look at whether we're in the midst of really a paradigm shift when it comes to prices. Hi, Warren. Thanks for being with us.
Yeah, thanks for having me. Happy to be back on Real Vision.
Happy to have you. So you wrote in one of your recent research reports, it really caught our eye that there's a new world order. What does that look like? What's that new order look like?
Well, we're at 314, we're really about quantitative rules-based systems, and we build models, and that's really our guardrails for navigating the financial markets. And, something that's really important to a quant is how assets move together. And the defining feature, what I would say the defining feature of the last 25 years has been, really since 1998, let's call it, has been this negative correlation between stocks and bonds. And so, for asset allocators, if you're running a traditional 60-40 portfolio, bonds, the bond side of your portfolio has given you a really nice hedge over this period of time. And I think it's made life pretty easy for you if you're an asset allocator. So, that to me has been the defining characteristic since 1998. We can get into why that is, but I believe the odds are rising that this kind of negative correlation is going to dissipate over the coming years. And this is what we see on a long-term basis. This is not necessarily something that's going to happen tomorrow, but we see this unfolding over the next 25 years. So the big picture view and the impetus for us starting 314 Research was that we didn't think the next 25 years were likely to resemble the last 25 years, and specifically the co-movement between stocks and bonds is going to change.
Yeah, and that's going to have huge implications for everyone because we've all been really indoctrinated into this idea now that they do move in opposite directions. It's a hedge, and we should always be thinking about that, whether you're a professional investor and trader or even just looking at your 401. That's been hammered home to everyone that bonds are the hedge to stock volatility. So talk to me a little bit about what you're looking at. Why do you think this is changing? What are some of the things happening in the economy that are causing that correlation to break down?
Yeah, really quickly, I want to just give you one stat for everybody to remember as we move through this conversation, when we talk about the co-movement, the negative correlation between stocks and bonds. From 1998 forward, if you took just the 100 worst equity days, so the days where the stock market was down the most, bonds were up on 83 of those 100 days, almost a perfect hedge during true equity turbulence. Before that, if we take the history of the stock market before that, the 100 worst equity days, bonds were down with stocks most of those days. So 65 out of those 100 days before 1998, bonds were down. So this is really a phenomenon that has arisen since 1998. So with that in mind, we have to ask ourselves, what happened in 1998 that gave rise to this condition? And so that's where we can get into what we see changing in the economy.
Yeah, to understand why it's changing, you have to understand why it happened in the first place. So talk to me about what is the significance of that? What did create that? And then we can get into why it's breaking down.
The big picture view is globalization really took off around 1998. So we had, and I do believe that crises bookend these big changes, these secular changes. And so in 1997, 1998, we had the Asian financial crisis, which really set the table for Asia becoming the manufacturer of these big changes, these secular changes. And so in 1997, 1998, we had the Asian financial crisis, which really set the table for Asia becoming the manufacturer to the world. Asian currencies were hit, and that allowed for a cheap workforce and manufacturing base there. But we had a number of events coming off that 1998 timeline. So 1999, the euro begins trading. 2000, we permit China into the WTO. And all this shows up really, the way we have evidence for this, that this is a major disinflationary impact on the U.S. economy, is through looking at the price of durable goods. So we make stuff over in Asia, and what happens to those prices to the U.S. consumer. And if we show the chart of U.S. durable goods pricing since 1998, it has been the big component of deflation or disinflation within the consumer price index. And so I think we can say safely that this rapid globalization that occurred around 1998 to 2000 was the proximate cause, or a major cause at the very least, of the disinflationary tailwinds that we've seen since 1998.
And those were significant price declines too. We're not talking about sort of marginally discounting. We're talking about an era where people saw prices fall significantly. Things were just they were getting too quicker, and the price was falling and became within reach of many people. I mean, this was a significant change.
Right. And what's interesting, if you plot the path of durable goods prices versus that stock bond correlation we talked about at the beginning of the program, if you plot that, it really they track each other. From 1998 forward, you saw durable goods pricing rising up into the late 90s, 2000, and then rolling over all the way through into COVID. And the same thing has happened with the stock bond correlation. Stock bond correlation was positive and then became negative as we went from 1998 forward. And the reason we think these things are connected is because when you step back and think of the stock market and you're just boil it down to the basic components of what drives the market returns for stocks and bonds, it really can be boiled down to economic growth and inflation. So if you have this structural, secular, deflationary tailwind, disinflationary tailwind coming out of Asia and China in particular from 1998 forward, you kind of remove this risky inflation from the equation of stock and bond prices. So what then is left to dictate returns between stocks and bonds? It's just growth.
Yeah.
And so in that world where it's just economic growth, if growth rolls over, stocks are hit, bonds get bid, yields come down. And that's been the pattern that we've seen for 25 years basically at this point. The other factor that kind of piles into that is you have current account surpluses built up in Asia. Those dollars get recycled into the treasury market, so you get a persistent bid into the treasury market. And then finally, if you look at the term premium for U.S. bonds, you've seen term premium basically collapse. That means that there is no premium on the back end of the curve for owning those bonds. And to me, when I look at that, you can explain it a couple different ways, but I believe what it shows is asset allocators have begun thinking of bonds as a pure hedge for their equity book. And so all these factors follow in from the disinflation in globalization that we saw coming in 1998.
We at the same time we saw those durable good prices going down too. We also saw energy low, right? That's another. I mean, it wasn't like those prices were down and you had inflation in terms of energy. You also had very low inflation. I mean, at some of the years it was incredibly low. I can remember where oil was and the price I was getting on a round trip ticket to London. It cost me cheaper for me to go to London than it was for me to go to the West Coast. It was incredible, but that felt so different. We just didn't have to worry about inflation anywhere, really.
Yeah. And I mean, that brings me, I would say it's a good point. And the second, mini secular force that has held down inflation over this period of time is really the Shale Revolution. So, basically the combination of horizontal drilling and hydraulic fracturing in the United States, we were able to unlock a big pool of hydrocarbons from, call it 2011, 2010 on, and the price of crude oil collapsed in 2014 forward. And if you look at a picture of U.S. CPI versus really the Fed's 2% per year target from 2014 forward, that's when CPI divorced from that 2% target. So the Fed has been unable to hit its target since then. So I think, again, the evidence points to the Shale Revolution and kind of the abundance of hydrocarbons that we've had over the last 7 years, providing another disinflationary tailwind to the market. And again, everything leads back to the same analysis or conclusion I had before. When you remove that structural inflation from the market, the stock bond correlation turns negative, and ultimately it's a boon for asset allocators.
And when we talk about globalization, when we talk about the Shale Revolution, the drop in prices, a lot of people thought of this as a permanent trend. I mean, you didn't think they weren't being discussed as, we have this opening up, this globalization. I always thought of it as technology was bringing the world closer, breaking down barriers. And this was a shift that wasn't going to reverse. Do you see that it is changing now?
Yeah, I do. I think that, as I said, I think we have a tendency to see these crises bookend periods of history, secular turning points, just like the Asian financial crisis led us into this period of history. I believe there's a good chance that COVID is going to break that, bookend that whole era of disinflation. And so, we came into COVID, and I think there was already icy U.S.-China relations that had been kind of growing under the surface through kind of the Trump years. And then I think the supply chain issues that we're all dealing with right now hit. Yeah. And I do believe this has kind of given the American voter a chance to rethink whether they like the deal that they have with globalization, where China manufactures a great deal of our products. And so, we got cheap, durable goods off the deal, but what did we give up? And I think that the cost side of that equation, not to sound protectionist, it's just what I think is happening, is the cost side of that equation, I believe, wasn't considered over those years fully, and COVID has caused us to rethink that. Yeah. And so now you're seeing evidence that there is a movement, I believe, to not totally do away with globalization, but to change those global supply chains to make sure that it's not just purely economic considerations that go into where we produce our goods, but other considerations, geopolitical considerations as well.
Yeah. It's so interesting, Warren, the conversation, it seems that people are more willing to rethink their supply chains and whether they need to draw them in when it comes to just thinking about it from a goods perspective. I can't get my goods, and I'm losing out on business because of that. One of the things that has kept those supply chains just in time and global isn't just the goods, though, right? It's wages. I mean, it was cheap wages and the ability. That's what kept those costs down. When I remember years ago, I had a conversation with somebody who was really looking ahead and said, at what cost do we have this cheap labor when we're gutting the middle class here in America? Nobody wanted to listen to that. Nobody particularly cared or could wrap their head around that when it meant potentially higher wages here, when it meant you could get your refrigerator for, $1,000 less than now. Everyone, because of the inability to get goods, is thinking about that. But aren't we going to get caught up on that same wage issue? You can bring your factors in. That's going to make sure you have access to your materials, but it's going to cost more.
Right, and that's why I wouldn't say that it wouldn't be feasible to make a prediction that we're going to bring all this manufacturing back to the United States per se. But I think just the world works incrementally. Ultimately, there's no light switch that goes off and on for globalization. It's not full on one thing or the other. I think that the most likely end of this, and we've seen already, I think, the beginning stages of this movement, even through the Build Back Better plan, there are numerous tax credits for reshoring or onshoring manufacturing. And I think that's just the tip of the iceberg. And so how does this play out? Ultimately, I think it will be probably a reworking of supply chains to be more regional. So it doesn't mean we manufacture necessarily everything in the United States again, but at the same time, maybe we don't want China manufacturing key pharmaceuticals or to offshore the semiconductor industry. Maybe we're okay having our textiles and shoes built in China or other far-flung places, but maybe we want to have most of our manufacturing base, our key manufacturing base, within more of our orbit of control.
Semiconductor chips, when you're talking about batteries for EV, the things that are plugging into more, national security or economic, vital economic issues. So if we do that even a little, even at the margins, if that starts to happen, are we now looking at an era where we have higher inflation in both goods and energy as part of our new normal?
Yes, that's my ultimate feeling, is that this has been, and it really is stark when you look at the price collapse of durable goods in the United States over this time period, even just a rethinking of the supply chains. If we roll that back somewhat, that's going to be a major inflationary headwind to the markets. And I think that by itself can reshuffle the deck, the cross-market relationships that we see, the whole market structure that everything's been built on, really. 60-40, all of your back tests, everything in finance runs off of that assumption that stocks and bonds trade against each other. And so I think it's a big deal, and I do believe that's what we're setting up for, is this this sea change where, we're basically going to have structurally higher inflation due to that shrinking of globalization that we're talking about. And the other factor, like you've alluded to, is the increasing price of hydrocarbons and ultimately the dissipation of shale exploration.
So if the relationship between stocks and bonds is breaking down, that negative correlation, what's going to replace it?
I think that's really the key question. And there isn't much, when we look back in history, there isn't much, I think, that can fill that void the way that bonds have. So I think ultimately you need to have, our solution at 314 is to broaden your asset menu. So when you're looking out as an asset allocator, you need to be first start by expanding the available assets outside of just stocks and bonds. For us, we've had a big focus. My background came from the energy and commodity space, so we have a big focus on real assets. So our core model, real asset allocation model, has 17 different assets in it, including cash included in that, and we can rotate into it during periods of market strength, Bitcoin, commodities, gold, real estate. These assets, they aren't going to ever have the same negative correlation. We've done all this analysis historically for everything we have. Mm. They're not going to have the same negative effect, hedging effect that bonds have had, but you need to be flexible enough to find strength during these periods, especially during periods of inflation where we could have structurally higher commodity prices and real asset prices in general. So you need to have that outlet available to you as an asset allocator. And that's a big picture answer, but then you have to drill down and figure out how to actually implement it.
Exactly. And I have questions about that because it's the nice thing about the stock bond correlation is you didn't have to think very much about it, right? It was just U.S. Treasuries. But before I do that, you mentioned gold. What about gold as a hedge? We get so many questions about this, and I feel like so many people, thought gold was finally going to have its moment. Those, the people when gold's been doing nothing in this deflationary period, and it was finally ready for gold to break out, and it just didn't. Why isn't gold? Why doesn't it work as a hedge? And will it ever? Is it still just a timing thing, or is it just do we just have to stop having that conversation?
No, I mean, I think that. Well, one thing, gold's a tough asset to nail down. It is. It always has been. When we wrote our big gold report earlier this year, we started by saying gold's a chameleon asset, and meaning that it can look like one thing during a period of time and transform into something totally different in another period of time. And so whenever you build a model around gold, you have to be cognizant of that, and you can't get too rigid with how you classify it. So this is something it's frustrating, but it's always been with us when it comes to gold. Something that I think is particular to this cycle is the rising of Bitcoin, right? So crypto comes onto the scene. Our thesis when we made crypto and Bitcoin a big part of our model, our thesis was that Bitcoin is not competition to the US dollar. That's kind of a foolish line of thinking to think that Bitcoin is going to replace the US dollar, but it is competition to gold. We think that it does steal some of the flows from gold. And interestingly, we have our model. So we have a trend component and we have a machine learning component. The machine learning component, it basically takes all these cross assets, and it doesn't have any of the bias that like I have or any human macro forecaster has. It's just looking at price movements, volatility, and grouping these assets together. So when we peeled that model open and we looked at how is this algorithm grouping different assets, interestingly, it put gold and Bitcoin in the same bucket. And so to me, that was fascinating because it kind of confirmed my belief.
Even though they don't move, why do you think that happened? Because the price action seems so different. We see so much activity in Bitcoin and not really gold. Why did that end up like that?
I think that's why you need to use somewhat advanced algorithms when you're doing these asset allocation groupings, because if you just try to do a straight correlation, like a daily rate of change or weekly rate of change, you don't see a lot of co-movement in these assets. But when we do a whole matrix and add a machine learning component where it's taking all of the assets available to us and then looking at each one against each other, it's finding a relationship there, which I thought was fascinating. It's kind of over I think our head, that's why you need to use the machine learning. But the fact that the computer found that was quite fascinating to me. And so in our model, because that's how they got grouped and bucketed, and this works on a 3-year rolling period, so this changes and evolves all the time. But at this point in time, they're grouped together. And so our model, if we have a Bitcoin weight, it's going to take from gold ultimately to stay diversified. And I think that's a lesson for not just how our model looks at it. I think that's how a lot of human allocators look at it as well. So that's a factor holding gold down too right now.
Yeah, that's interesting. So, I've heard debate about this because we've heard Kathy Wood and others say that Bitcoin can be an alternative to bonds. And then about other people just flat out say that there's just no way. Do you see it as an alternative to bonds, or do you see it as a good hedge to stocks? How are you viewing it?
No, Bitcoin's absolutely not a good hedge to stocks. And so what we did is we broke down how does Bitcoin. So people say Bitcoin is uncorrelated to stocks, right? And that's somewhat true. So again, if you run a very unsophisticated straight correlation of stocks and Bitcoin, you see an uncorrelated pattern. The other thing that's uncorrelated is Bitcoin can collapse, and it doesn't, so far, historically, it doesn't infect the broader equity market. So Bitcoin, just like early in the year, was down 40%. The equity market didn't care. It just kept going higher. Now, it's not a systemic asset yet. Now,
yes, that's exactly what I was just thinking.
Right. If equities collapse, Bitcoin gets hammered. So we broke the correlation apart on equity down days versus like big down days. Bitcoin gets hammered.
It's risk off.
Exactly. It's leverage. It's more or less a beta to the stock market. And so when the market is a systemic asset. So if you're getting hammered on the stock market, you're probably long Bitcoin, you're selling some of your Bitcoin. So especially if you're long tech stocks, which are leaders in the market, and those start falling apart, you are going to end up seeing weakness spill over into Bitcoin. So the beta goes from basically 0 to about 1.6. So it's 1.6 times the market's down points during these high volatility periods. So you have to break it apart and be nuanced when you think of Bitcoin as a replacement. And the bottom line is that it will not hedge your equity portfolio. You're just going to end up with more beta to the equity market if you add Bitcoin.
Warren, as somebody it sounds like the RAM model that you're operating off of, the real asset allocation model, as you call it, is diversification is everything.
Absolutely. Yeah. I mean, it's about being able to be flexible, find the right areas of strength using trend following, and then ultimately, being able to shift wherever that strength shows up. I've seen some chat of people there are obviously people who are sitting on really big Bitcoin gains right now. Based on how you feel about diversification, there are people who are trying to figure out, do I hold on to them, or do I start to take profits in an orderly way? It's hard. A lot of people feel very convicted about this asset class. What is your recommendation anytime you're sitting in any kind of asset? By the way, some people have that with metals as well, who did really well, got in that metal trade early. Yeah. How should they think about positions if they're sitting on big gains in terms of what they need to do and how they should be diversified? Well, the number one thing you need to do is not become attached to a position. You're not marrying a position. You're not marrying an opinion.
It's hard.
Yeah, I mean, you're only marrying a person, not a position. That's important to remember.
That's a great tagline. Only married people, not positions.
Yeah, if you need to be what I say is strong opinions loosely held. So you have to have a strong opinion. You have to be ready to disengage and detach from it if the evidence changes. And so one of the things we do with Bitcoin, because it's such a volatile asset, you have to rebalance aggressively. Mm-hmm. So our model rebalances monthly. So that's number one. So if you have a targeted allocation weight every month, don't let that thing run from your target. Rebalance aggressively. It's basic, but it's necessary. And we have a lot of studies that show that helps your overall returns. And for right now, what's the outlook for Bitcoin? Our models are really overweight in long Bitcoin. We have a Bitcoin model. We have a volume by price analysis, and we also use the real asset allocation model. All those things point to higher Bitcoin prices. And what we see fundamentally driving this is just we had the first ETFs approved for Bitcoin. And like we said, we don't see Bitcoin as something that opposes the dollar or contests the dollar's dominance. It actually supports dollar dominance, because the use case we see for Bitcoin is that it's a vehicle to transfer wealth from these closed economies like China into more free economies that respect private property rights like the United States. And so this was something we proposed early in the year, that this is a supportive of dollar dominance. And since then, we've seen China repeatedly attempt to ban crypto in all these different ways. And now we're seeing the first ETFs approved out of the United States and some regulation. And regulation equals acceptance. That's our big thing. It's like when we see the U.S. regulate, you should welcome that as a crypto investor. And so I think that's what's happened. It's been a really important few months. We've seen this thesis confirmed in the actions of China and in the actions of the United States. And so now we have all these ETFs lined up like the ships off the coast of the LA port. And these ETFs are lined up in queue, and they're going to keep coming through and getting approved by SEC. And so there's a bunch of pools of capital just waiting to get access to this asset. And I don't think you want to be underweight during this period of time. I think you want to maintain your overweight and make sure you're here while all this capital tries to fit through a door that's about this big.
Wow, that's fantastic. When we're talking about that diversification, I think you said there was something like 17 different assets you have in the model, or that. It strikes me that are people going to have to be a lot more engaged in their investing now? Because when you had 60-40, you could kind of, as long as you were diversified or held your stocks in some people just put them in S&P 500 or a broad ETF and basically checked it again next year. Or if it's a longer term investment that you're holding, you always knew as long as you had that 60-40 mix that you were pretty protected. Across 17 different assets, seems like you really need to pay attention, or at least, as you say, rebalance and constantly check on things.
Yeah, absolutely. It's going to get a lot harder coming out of COVID, as the changes we laid out at the beginning of the conversation flow into these cross-market relationships. Investing is going to get a lot harder. Your bond side of your portfolio is already, you're starting today at 1.6, 1.5% on the 10-year. So you're fighting an uphill battle if you want to get any kind of traditional return out of your 60-40 portfolio already. And so. Yes, I think it's going to get much harder. You're going to have to expand your asset base, be a little more sophisticated, probably a little more turnover involved in that, and a little more babysitting of your portfolio. But I think it'll pay off. It's only, in my view, that's the best, meat and potatoes way forward.
Yeah. So now, if we understand that bonds are not necessarily going to be the hedge they were, what's your forecast for stocks? We're sitting at close to those highs again. We've got, a lot of stocks are still showing enormous gains. What's your forecast ahead of time? Because if we're looking at a higher inflation, into 2022, I should say, on the horizon, we're looking at higher prices, higher energy prices, higher inflation, maybe less globalization. That does not sound like a recipe that's positive for stocks.
Yeah. So we've been it's a couple of things. Number one is I don't like to do forecasts but we have to do it in this business, right? But I always give that disclaimer that we run with our models. I think it's important to say that at the outset. Like, it can be frustrating because everybody wants to know your opinion, but trust me, if I can see the future, then,
Yeah. And you already say you're nimble and checking it all the time. So we're not going to hold you to but generally, how are you?
So we come into 2021, we were really bullish. And I'd say all our models are still riding those basic trends. We have reduced the massive equity overweight we have from more or less market weight or overweight real assets at this point in the cycle. When we look out at 2022, honestly, we see a lot of bearish factors building. So I would be cautious going into 2022. So we already all know that valuations are high. We wouldn't use this as a timing tool, but we have a basic model we use that takes the CAPE ratio, adjust it for interest rates. Even for low interest rates, the market looks like it's about 25% overvalued from here. So you can look at that and say, okay, there's quite a bit of downside if we do have some negative catalysts. So there's that. I think an important one for next year is going to be the election cycle. So midterm election years are historically poor years for the stock market. And I think next year could be even worse than typical because this market has run off of fiscal stimulus. And so if we were to have a scenario next year where Democratic approval levels, like Biden's approval levels, stay low, and the voter base for Democrats seems like it's not going to be energized, and it could be a sweep of the House of Representatives and potentially even the Senate. For Republicans, we're looking at gridlock. The market will read that as austerity, so you're taking away some of that fiscal stimulus that the markets run on, and I think the market will use that as an excuse to sell off next year. And typically, when you look at midterm election years, you get weakness about 4 to 5 months before the November election. So that's typical. I think it could be pronounced next year. Looking at the back half of next year, I think that OPEC's adding 400,000 barrels a day of oil back to the market. And to me, I don't think that oil prices are going to run away from us right now. So I think that's going to cap oil prices as we enter next year. We go through this winter season and the energy crisis that we're dealing with right now. But as we get to the back half, the very end of next year and into 2023, OPEC spare capacity is gone. Demand is back to pre-COVID levels, oil demand. And I think we now are entering that period of time where these structural inflationary headwinds could really start to come through in the market and cause problems for investors. So that's kind of in the later half of 2022.
If oil prices kind of stabilize at this higher level and then face the potential to move higher if spare capacity is gone, and we see this chronic underinvestment is going to bite at some point too if demand stays or demand comes back. Do you like the energy sector from an equity point of view?
Yeah, we do right now. We have another model, the yield optimizer model, where we take 12 income producing assets, including energy in there. We also have cash, which would be the 13th asset in the model. Energy is the largest weight in that model right now. And it's been that way for a few months now. And so we're going to ride that from a trading basis. Now, what I call full cycle, what you can hold through the full cycle, even as this OPEC spare capacity is reduced and supply comes back online and potentially get weakness in the price of oil. I like the large cap Canadian producers, and that's what we've been recommending to our clients for a full cycle place to go. I mean, Canadian production is already above pre-COVID levels, whereas you look at shale, and shale production is 2 million barrels below where we were coming into COVID. And the other factor is it takes a lot more maintenance capital to maintain a shale well, because we have such high decline rates when you're drilling for shale. It's like 40% in the first year. So there's this shale treadmill that you get on where you need to keep pouring capital into these projects in order to maintain production. Well, in Canada, you're dealing with oil sands, and basically it requires no maintenance capital. So you have this. Once the mine's up and running, it's a lot easier to continue producing. And I think that's the perfect energy investment for this environment. So that's how we've positioned our clients. I
think Canadian Natural Resources, is that one of the names that is on your list that you like?
Yeah, we have them in Suncor. So we're staying really large cap and liquid, big safe producers. When you come off just the playbook really quick, when you have a acute low in the price of oil, you go to like low quality, high beta. We're not there anymore. Our theme across markets has been to shift into high quality. And this is especially true when you're dealing with the energy space. And so, yeah, I mean, we had Suncor report earnings, I think it was yesterday. We've been recommending them since last year into this year. And they've been lagging. They finally caught up. They doubled their dividend, increasing the buyback, paying down debt. I mean, they're doing things you want to see an energy company do in this kind of environment.
Interesting. I don't see any of the U.S. majors on your list. You prefer to stay away from them, or the big global, Exxon, Chevron.
Yeah, I mean, if you're playing our stuff, so we have a couple of ways of measuring things. So we have a sector model, and we have the yield optimizer model, and both those things we would just buy the XLE energy ETF in both of those cases. So you would get almost, exclusive large integrated exposure through that. But again, I look at that as kind of a trade. I don't want to marry that. I'm trading with that at this point in time. And so what I would like to own for the full cycle, it's those large cap Canadian stocks. I think you see those things outperform going forward.
If we're looking at an inflationary environment, and we certainly have seen the market upping its interest rate forecasts and the expectations there, do you like financials against that backdrop? People have been looking at them and they haven't really delivered yet. They're looking at them again. Where do you come down on financials?
Yeah, I mean, second best performing sector for the year. We've been in and out of it all year. We're in it again right now. We have a really easy, I'd say, way of judging when you should be in financials. Number one, there's two things. Number one, our sector model, which financials is one of the largest overweights in that model. Rebalances every month, and so we'll take another look at it, basically close the trading today and see where it ends up. But I think financials, based on their relative strength, will be in there. And the other thing we look at is we basically take a 3-month regression trend line and look at two things: the slope of 10-year yield. So basically, is the 10-year yield rising? And we look at the slope of the yield curve defined by the 2s and 10s spread. So is the yield curve steepening, and is the yield curve rising, or is the actual interest rates rising? If both of those conditions are met, historically, you get massive outperformance from the financial sector. And that's what we're getting right now. So we see those conditions. We see our sector model. It's been one of our high conviction areas for the whole year, is to ride certain financials.
Does the growth outlook have any impact on any of this? Because if I'm thinking about, the broken supply chains, a pullback from, free global trade, higher inflation, higher interest rate. I mean, this is all, are we looking at a subpar growth outlook?
I highly doubt we're going to get subpar growth. So we look at lots of macro factors, right? And so at least for right now, I think the market, we could look past the data and into fiscal stimulus, like I said, next year when we get into spring, summer of next year, and we start thinking about midterm elections. But for now, all the macro stuff in the U.S. looks really good. And so we track, one of the best pieces of data we have is daily tax withholding data. So it's just showing us a real-time look at what's happening to the average American consumer. And that hit a new year-over-year high this year. And it's still really elevated. And so historically, you don't want to fade that signal. It's a really positive signal for the U.S. Macro backdrop. The other thing we've seen is what we're calling a Capex cycle. And you usually see, if you see GDP growth and inventories falling, which is what we've seen as a result, somewhat admittedly, of the supply chain issues, it still means that there's going to be a lot of demand to refill those inventories in the coming quarters. We just got a GDP report where we saw some inventory bumps. I think you keep seeing that. So that's going to be an increasing demand pull from the macro side in the U.S. I think if you're looking for areas of concern in the global macro picture, you're going to China right now, and you're trying to understand what they're doing with the property market there, and basically could anything that happens there spill over into the U.S. economy. So we had a chart we look at, the Chinese credit impulse has turned negative, and when that happens, you usually get kind of a deflationary wave through the global economy. So the question is, will that kind of follow through, or are we going to be offset by the U.S. Inventory cycle, Capex cycle that we're seeing? So net, I think we're in a positive for the U.S. Macro backdrop, but there are problems in China.
Warren, do you have any, it seems like most of the things in the sectors you like are in that sort of energy space, or you mentioned real estate. Are you completely staying away from tech? Is it something that you short, or you just don't have you don't have a large allocation in your model?
Well, we're actually overweight tech in the sector model, which I thought was an interesting kind of Paris trade. The way the model came out is like we're overweight tech, overweight financials, and overweight energy in our sector model. And we're underweight consumer areas, consumer discretionary, consumer staples. Healthcare is a big underweight right now, too. So that's how our model shakes out. Now, everything changes from month to month. And the one thing I'd say that's kind of a red flag out there on the horizon is our real asset allocation model has been running a big NASDAQ overweight, and that's been cut in half in recent days. So You are starting to see maybe, and when I look at the big picture message of our models, everything, the duration is getting shortened quite a bit. So you're seeing commodity overweight, you're seeing treasury bond underweight, tech is kind of getting pared back here even. And so when I see that, I see short duration, near-term economic growth, rising interest rates, that kind of environment being kind of predicted by the model.
Yeah, so it's so interesting and seems so timely. Just finished talking to somebody else who's also looking at small cap, long small cap, and short QQQ as well. So it's feeling, I think, a little heavy to everybody. Warren, some fantastic insight there. Thank you so much. And it certainly sounds like we're all going to have to plug in and pay a lot more attention if the 60-40, that correlation is broken. We're going to have to do a lot more, roll up our sleeves and do a lot more work.
Absolutely. Yep. So, yeah, absolutely.
Great. All right. Warren Pies, founder of 314 Research. Thank you so much for being with us today. And thank you all for watching. The conversation continues over on the exchange. In the meantime, take care out there and good luck.
Thank you. Appreciate it.